I have a feeling that we're going to see these deficits rising throughout the year, and that ultimately 2024 is going to have a record high current account deficit, and then that record will probably be broken in 2025. And again, anyone who says we have a strong economy, look at the current account deficit. That's a report card on the economy. It is an F. It's an F minus. Right? So you can't claim to have a strong economy when you're bleeding red ink in your current account.
Amidst hopes for interest rate cuts by the Federal Reserve this year, those expectations are steadily fading. Recent statements from Fed officials emphasize their commitment to keeping borrowing costs high to combat persistent inflation, which continues to be driven by lingering pandemic-related factors. From apartment rents to auto insurance and hospital prices, these inflationary pressures are stubbornly persistent, prompting Fed officials to stay cautious and wait for signs of cooling in these sectors. Legendary investor Peter Schiff highlights that the Fed's strategy to tighten monetary policy aims to rein in an economy threatened by mounting inflation. By restricting the flow of money and credit, they seek to prevent runaway price increases and stabilize economic conditions. However, simultaneously, government-backed mortgage guarantees inject liquidity into the housing market. This influx of funds can stimulate demand for homes, driving prices upward, a scenario reminiscent of the pre-2008 financial crisis housing bubble. Such divergent policies challenge the Fed's inflation-fighting efforts and raise concerns about potential asset bubbles and market stability. Despite a recent decline in the inflation rate from its peak in mid-2022, with the Consumer Price Index showing a 3.25% increase in May, down slightly from April's 3.36%. This economic backdrop has led to mixed public sentiment, where inflation's decline in importance is tempered by ongoing economic anxiety. Reflecting on the lessons of the 2008 financial crisis, Peter cautions that the expansion of government guarantees for mortgages should be rethought. That crisis starkly exposed the dangers of lax lending standards and excessive risk-taking in the housing sector. Yet, rather than scaling back, the government has expanded its role, even guaranteeing loans for multifamily properties, which raises questions about sustainability and the potential for history to repeat itself. Now, we present the clips of Peter Schiff's insights from his recent video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
At a time where the Fed is trying to fight inflation. I mean, that is its most important goal right now, is fighting inflation. And now you have the government doing something so counterproductive as guaranteeing second mortgages. But not only, does this fly in the face of what the Fed is trying to do, and so now you have, again, more examples of the government and the Fed working at cross purposes. But it also shows that the government never learns from its mistakes. And in fact, it never stops repeating its mistakes. And the reason that the government doesn't learn from its mistakes is because it still doesn't understand that it made the mistake. You would think that after the financial crisis of 2008, the government might have learned its lesson about the dangers of government guaranteed mortgages. But no, I mean, not only has the government not stopped guaranteeing mortgages, it guarantees more mortgages than ever before. In fact, following the 2008 financial crisis, I forget exactly when, I testified against this in Congress and it passed. But the government began guaranteeing multifamily mortgages. So if you buy a duplex or a fourplex, the government will guarantee that loan too. Now, remember, the whole purpose of the government guaranteed mortgage in the first place was, to help people qualify for a mortgage, right? The goal was to have more home ownership. And so the government promoted that goal by guaranteeing mortgages. Well, if that's the goal, and it's not even a goal that should be pursued, but if it is the goal, then why do you guarantee multifamily? Because these are investment properties. So if somebody's buying real estate as an investment, why should the government guarantee that loan? mean, clearly it's not just trying to help somebody try to afford a house. You're helping somebody start a real estate business. That's not why the government initially got into the business of guaranteeing mortgages. So again, once the government gains some type of power, it constantly expands that power well beyond the original intent of why it got the power. And of course, part of that goal with guaranteeing mortgages was to help make home ownership more affordable. Because when the government guarantees the mortgage, the borrower can get a better rate than if the government doesn't guarantee the mortgage. And that was supposed to make it more affordable because the borrower could get a lower rate. Because when the government guarantees a mortgage, that mortgage effectively becomes a U.S. Treasury. Now, there was never an explicit guarantee on those mortgages. It's implicit. And so mortgages had a interest rate that was a bit higher than U.S. Treasuries for the same maturity, but not that much higher. And certainly significantly lower than if the borrower had to rely on his own creditworthiness to get a loan, because obviously he'd be a lot less creditworthy than the U.S. government. And so the banks would charge a commensurately higher rate. And so by getting this government guarantee, the borrower gets a lower mortgage, and therefore homes are more affordable. Except it backfired on the government, because once the government started guaranteeing mortgages, well, then it became easier for home buyers to take out bigger mortgages. In fact, the banks didn't give a damn. As long as the mortgage was guaranteed by the government, didn't matter how big it was. Now, the government had loan limits, so if the loan was too big, then the government wouldn't guarantee it, and then the banks wouldn't make the loan. But as long as you borrowed within the government limits, the government didn't give a damn. I mean, the lenders didn't care, right? Because it was government guaranteed.
The current account deficit is expanding rapidly, potentially reaching new record highs by the end of 2024 and beyond. This deficit isn't just a figure. It's a stark indicator of underlying economic vulnerabilities that demand attention. Adding to these concerns are disappointing retail sales figures, a critical gauge of consumer sentiment and spending. May's retail sales figures fell well short of expectations, initially anticipated to rise by 3%, but managing only a paltry 0.1% increase. When adjusted for inflation, these numbers paint an even bleaker picture, revealing actual consumer purchasing power and economic activity declines. Interestingly, amid these economic challenges, Peter sees that the dollar has demonstrated unexpected resilience, maintaining its strength despite lackluster economic reports. In contrast, gold has been volatile, reacting sharply to even minor shifts in economic data. For example, a stronger than expected PMI reading in June briefly lifted the dollar and caused gold prices to plummet, underscoring the market's sensitivity to any hints of economic strength amidst broader weaknesses. These developments underscore the complex economic landscape policymakers must navigate, striving to foster growth while managing inflationary pressures and external economic risks.
Now, I looked at the Q1 deficit in 2022, and it was actually quite a bit larger than the Q1 deficit in 2024. So we'll see what happens for the rest of the year as to whether or not we can beat the record high. I think we can. I have a feeling that we're going to see these deficits rising throughout the year, and that ultimately 2024 is going to have a record high current account deficit, and then that record will probably be broken in 2025. And again, anyone who says we have a strong economy, look at the current account deficit. That's a report card on the economy. It is an F. It's an F minus. Right? So you can't claim to have a strong economy when you're bleeding red ink in your current account. Now, another very weak data point that came out during the week was retail sales. And everybody is looking at the consumer, and the May retail sales numbers were horrible. The expectation was for a 0.3% rise, and that was from a flat. Well, April was revised to minus 0.2, and May was only an increase of 0.1, not 0.3. but it increased from minus 0.2, not 0. So it's a huge miss. And again, it's not adjusted for inflation. So retail sales actually fell if you adjust them for inflation. In fact, they fell without adjusting them for inflation in April by 0.2. What's going on? Americans are paying more to buy less. That's American life. And in fact, X vehicles, we were minus 0.1 in May. That was versus expectations of plus 0.3. And for the prior month, April, which was originally reported as plus 0.2, that came out as minus 0.1. So you have back-to-back falling retail sales X cars, not adjusted for inflation. If we did adjust them, it would be an even bigger drop. And the same thing with X vehicles and gas. The prior month is now minus 0.3 instead of minus 0.1. And May, which was supposed to come out at plus 0.3, came out at plus 0.1. But it came out at plus 0.1 from minus 0.3. So if we hadn't revised the prior month way down, then this month would have been down. So these are horrific numbers. If you're looking at retail sales as some kind of driver of the economy or barometer of the economy, this was a horrible number. I'm surprised, really, that we haven't seen more weakness in the dollar because we've seen strength, and we haven't seen any strength in gold. Gold's been flat. In fact, we had a lot of volatility on Thursday. We did get about a $30 rise in the price of gold. And then on Friday, we got almost a $40 drop in the price of gold. And the catalyst there was we got one data point, the PMI for June, that was stronger than expected. Instead of coming in at 54.5, it came in at 54.6. And the manufacturing index came in at 51.7 versus 51. And the services index, which was supposed to be 53.7, that one was a bigger beat at 55.1. We got that one number, and the dollar, jumped big. Gold got clobbered immediately because we got one, strong economic number. Well, I mean, it's lost in the sauce of weak economic numbers. I mean, talk about an exception to the rule. Most of the economic data we get is weak.
Expectations for Federal Reserve interest rate cuts are dimming as inflation remains a persistent issue in sectors like housing, auto insurance, and healthcare. The Fed's cautious approach, waiting for signs of economic cooling, contrasts with government efforts to boost housing demand, potentially introducing risks to market stability. Despite recent dips in inflation rates, ongoing economic uncertainties continue to shape public sentiment and economic forecasts. Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.